Welcome everyone to another PushStart webinar. My name is Zach Forrest. Thank you so much for joining us. I have with me Mr. Stu Brauer, our resident expert in everything related to running a successful fitness business. And he is here for part 3 of our financial series, where we have broken down all the financial reports from the profit and loss and different varying models of managing money within your business. And we're going to wrap it up today going over the cash flow statement and the balance sheet. So, without further ado, Stu, take it away.
Awesome. All right. So let's go ahead here and get that you guys seeing what I'm seeing. So I need to borrow or get
Oh, yeah.
permission from you.
There you go.
Awesome. All righty, guys. Continue. Let's do this. All right. Cool. All righty, guys. So we big topic of conversation over the last several webinars and even some of the courses we put out here with PushStart has been around no offense to all my Excel geeks in the room, but all the boring documents that you could get from a CPA, bookkeeper, or if you like to geek out in QuickBooks, and what is the practical use of them? None of us signed up or got into owning a gym so we could look at cash flow statements or study P&Ls. But as we've discussed, and I'll always reiterate this, just like you probably reiterate to your clients and have them get comfortable with the uncomfortable, the only owners in the fitness industry that I know that are doing well by whatever definition that is are the ones who have gotten extremely comfortable with the stuff they don't want to do, like looking at these reports and understanding the cash of the business, right? If you'd make changes in the world and improve people's lives, that's great. We can't pay our rent with that. You can't pay your coaches with it. So understand where the cash is going in your business is really important. In this last part here, we're really kind of wrapping up the end of the significant in the balance sheet 101. A balance sheet provides you this time-stamped, documented summary of where your gym's financial position sits. It simply looks at what is it that you own, what do you owe, and any money that's invested in by the owners. It'll ultimately end up showing what your equity in the business or the net worth of the business is. Now, we've got a couple definitions we're going to dive into at a deep level, but just at a quick high level overview. When we look at assets of your gym, all right, we're talking about resources that will provide a future benefit to the owner. Something you own that is going to provide a benefit to you. That is an asset. And there's many different classifications of this. A liability is money owed. That is generally, for most of us, liabilities are going to look at things like loans. You can even look at your rent as a liability. Okay. Then there's equity and net worth. That is what's left over. When you take assets, subtract liabilities, what's left over, it would be your equity in your own company, aka the net worth of the company. Okay. But let's dive deeper because these need a little bit more detail to fully understand. And I'm also, I want us to understand when we are talking, like when you start Googling this, if you're like, I'm going to Google assets and see if this redheaded dude knows what he's talking about, it is much different in product-based industries versus service-based industries. Like if I'm the bookkeeper of a gym with monthly memberships and contract memberships, and I'm the bookkeeper of a restaurant, the assets would look different. And we're going to talk a little about that here, right here. So assets, again, any resource with a current or future economic value or will provide a future benefit to the owner. Okay. These are the things you own or money that is owed to you. So this could be, let's say you have $60,000 in your business checking account. That is an asset. Okay. Let's say you have 12-month contracts, okay? Recurring memberships on contracts. Someone has signed a piece of paper saying, I promise you that I will pay you this amount of money over this period of time. That would technically be an asset. And I'm going to stay here on these recurring memberships for a second. If everyone here asked their bookkeeper, hey, real quick, do you count my memberships, my recurring contracts? Okay. So we're talking like, think of 3, 6, 9, 12 months. Don't think of month to month. Okay. But are you counting my recurring contract memberships, if you have those, as an asset? I bet you 50% of the bookkeepers are, and 50% of them are not. But 100% of them are right. See what I'm saying by that? It is no right or wrong way to do this. You could make a great argument that a 12-month contract is an accounts receivable and is an asset. It is money you're going to be receiving for the next 12 months. But anybody who's had 12-month contracts knows that not every contract comes to fruition. That's why it's really important to kind of understand when you do contracts. A little side note, you have your, if the contract comes to term, it goes the distance, how much will I make? And if they cancel at some point early, what is the amount of money I'm likely to make off that contract? There's like these two numbers, right? And we generally end up somewhere in the middle, if not hopefully the very end. But it'd be interesting. Ask your bookkeeper, hey, are you counting my contracts, my long-term ones, as accounts receivable? In which case that would be in the asset column. Okay. I just, unfortunately, I sit on the side that I wouldn't count it as an asset. Me personally, it doesn't mean that if you do it's wrong. I just don't think so because it's not exactly practical because you're not going to go after that money in small claims court. It's not something that you can revoke or take. You can't take the fitness back from them or the sessions and classes they had back. It's not like a house, right? Like if you're building a house for someone, it was $500,000, that would be an accounts receivable. Well, if they didn't pay you, you could take the house back and still sell the house. Okay. So that's why products and services, it's different, but this is just a unique one. But equipment, all of your equipment in your gym is an asset. Your flooring is an asset. Things, tangible things, your front desk, if you had a custom one made, these are all assets, things you could sell that could have a future benefit to you. Land and buildings, if you own that, all right, in relationship to the business. These are all assets. Liability is much simpler, just money that is owed to someone else. If you owe it or have borrowed it, it's definitely a liability. So credit card debt, consumer debt, bank loans, payroll. If you looked at that, rent, if you have a mortgage on a building, these are all versions of liability. All right. This one's very much more cut and dry. Equity or net worth. Again, when we go ahead and we take our assets, subtract our liabilities, what do we end up with? And I got a case study here for us in a second. But that is going to be ultimately, when you look at a business, is this worth anything? If anyone here has ever thought about selling their business and you went to maybe your bookkeeper CPA to say, hey, could you help me crunch these numbers to see what is it, what is this thing actually worth? This would be one of these sheets, right, that they would be looking at, a balance sheet, to determine is there value or is there any net worth to this company currently. Now, those of you, and I'm saying this specifically coming out of COVID, anyone who got nice and trigger happy with the EIDL, and again, I did my fair share of EIDL shopping as well. Don't worry. We all remember that SBA website where you just took the little slider, put your mouse on it, and slid it to the right, and you could just borrow whatever amount of money you wanted. If you are over leveraged, meaning you owe more than you have in assets, that could be a tough position. And if you actually read the fine print of most of those loans, if the bank ever wanted to call the note, and calling a note means telling you, you owe everything due right now, immediately, like all of it right now, immediately, a lot of loan documentation, which I'm sure no one's ever read because it's really boring, actually says in there that if you're ever in a position, an over leveraged position, they could call the note on you. You see this in most SBA loans in the document language. But anyway, long story short, guys, let's not be over leveraged. Don't owe more than you own. So here's a great little case study. Here's an example. Okay. Let's say an assets, a gym has $32,158 in their business checking account. That's just kind of like a recurring balance or retained earnings that they have in their business checking account at any given time. In value and equipment, they've got about $93,000 in equipment, and they are counting their accounts receivable over the next 12 months at, a little under $20,000. You add all that up, you subtract their liabilities. They've got a pretty big SBA loan. They have credit card debt. They owe this amount on payroll for the rest of the year. And they have a lease liability of this amount for the rest of the year. We can all see that they have negative equity in the business. They owe more than they own. Not a great position to be in. Now, the interesting thing here on that lease liability, when you guys are actually running these, that's a tough one. Most of you guys, if you actually add up like an annual lease and you look at how much you spend in a lease, it's a lot of money. Again, you need to be generating more money than what that is. But I generally, if I'm ever doing analysis, I do include lease liability in here. I think it's also nice for everyone to see the number annually because we all think about it like You originally start thinking about a price per square foot, then you think about it monthly rent. But when you really think about what you spend annually on a lease, really kind of brings things kind of into perspective for any of us owners that have not wanted to really look at the numbers or not think about them a lot. You start thinking like, holy shit, I am spending, I mean, the amount of money I spend in rent every year is pretty insane. And then you can start thinking, am I getting a return on that investment? Which hopefully you are. Now we are going to switch to a cash flow statement. Okay. So we just talked about a balance sheet. Now let's switch over to cash flow statements. These track the ins and outs of the cash that is a coming and the cash that is a going. All right. And it allows you to see how effectively a company generates cash to then pay for their operating expenses or debt obligations and all that kind of stuff. So it could, and it also in real time would allow you to see how much cash a company has at that moment. So you could look at a cash flow statement and you could be seeing this is the money coming in, this is the money going out, and this is what we have on hand. All right. Again, every report that I'm showing here today, any QuickBooks or Xero is another popular bookkeeping software you have, will produce these reports like that, like within an instant, if you have everything set up properly in QuickBooks or Xero. Okay, so all these are not things that you would have to necessarily do a ton of work on. If you have that software and it's already hooked up to your accounts and you have it set up properly, you have access to this. If you have a bookkeeper, they can produce this for you at any given time. Now, here are the components of a cash flow statement. And this one there's some here that doesn't really have practicality, I believe, from a gym owner investment, a gym owner perspective, but we're going to share it anyway, because these are the three components of a cash flow statement. So the first one, you have cash coming in from your operations. We know what that is. That's our delivery of the service, whatever that is. Personal training, semi-private, group classes, whatever it may be. Cash from your operating activities, that's going to be here in that top section. Now, cash flow from investing, okay? If you have any short or long-term investments with the business here, that would be put here. So like if your bookkeeper is, let's say I'm trying to think of a relative say, let's say you had a 7,000 square foot facility for a few years, and then you realized it was actually a lot smarter and more efficient for you to drop down to a 3,000 square foot facility. You got smarter as you went on. But you're like, I'm sitting on all this equipment. And you sold a bunch of equipment off. You did a big yard sale. You sold things off. You reduced the size of your square footage, whatever. That may get classified here depending on where your bookkeeper puts it, right? You had made an investment in all this equipment, and then you sold it at a later date at a much lower price. It was a bad investment. But at the end of the day, it might pop up here in the investing activities if that's how your bookkeeper wants to put it in. And again, the part of this that Zach nor myself can give you any advice on is the strategy. Well, Stu, if I'm doing that, should we? I don't know. That's a great conversation for you, your CPA, and your bookkeeper. Understanding your state's tax laws, understanding, where your family sits in a tax bracket and what you're liable for, and all these other variables that are way above our pay grade. Okay. And the last section is cash flow from financing. This one's probably more practical for gym owners than section 2. Okay. This summarizes the sources of cash from banks or investors and the money paid to owners. A lot of small businesses, so let's call them single member LLCs here in the States, these are going to be self-funded a lot of the times, where the owner takes cash personally. Maybe they had money in a savings account, or they took out a HELOC, or whatever it was. Their dad gave them some money, whatever it is, and then puts into the business checking account. That's what we would call an owner contribution. It's an investment of you personally putting funds into the business for the business to then use. Because remember, you are two different things. There's you personally, and there is your business. This is where any of that activity would be classified and measured. If you're getting investment from people, if you're getting, investment, you're taking loans out from banks, LOCs, lines of credit, all of that would be here in the third section of your cash flow statement. Now, this is probably, if you're going to walk away with one thing from this today, I would hope it's this one, because this is probably the day-to-day, week-to-week, month-to-month most practical aspect of this webinar. Cash management. This is, and we've all been there, something that you don't realize you're doing a really crappy job of it until the consequences have already bit you in the butt. Poor cash management does not sting you when you make those poor decisions immediately. It stings you later down the road. You decided for whatever reason, Rogue just put out a brand new Echo rower. It is an overbuilt, incredible piece of equipment. And you decided, I have to have 12 of them. I don't know how I'm going to do business without 12 Rogue Echo rowers today. And you went and bought all that equipment. But then your HVAC went out. And in your lease, the landlord's not responsible for it. You are. And now those 12 rowers sitting over there, you realize, that was bad cash flow management. I had cash and I spent it on this when I probably should have maybe planned or strategized it better. So remember, bad cash management doesn't hurt you when you make a bad cash management decision. It will hurt you later on down the road, and that sting is 10x. So your ability to monitor, control, and optimize the amount of cash flow is referred to as cash management. While all the financial docs from, you go back and check out all the webinars that we've done, are incredibly complex, and your CPA and bookkeeper should 100% be your steadfast partners in making sure you understand these documents, that they are accurate, and that you are making strategic plans based on those documents. How you spend your money is no one's business or responsibility but your own. I always ask people, when you look at a P&L, what is the only thing in the P&L that you're in control of? It's the expenses. You don't have to have a Spotify subscription. You didn't have to choose an $8,000 a month building. You don't have to pay those employees. You can technically fire those employees, cancel Spotify, and you could have leased a less expensive building. The only thing you're not in control of is revenue, where that's not a button you can hit, but you literally can hit the cancel button, the fire button, and you could have chose a different lease to sign. Cash flow management, where we get in trouble, is not on the inflow, because you're not in control of that faucet. It is on the outflow. It's the only faucet you actually can turn on and off. If you could turn on and off revenue, well, none of you guys would be on this webinar. Let's just put it that way, okay? And I wouldn't be on this webinar either, all right? Cash management is your responsibility, all right? And it is what directly, bad cash management is just about what you spend money on. And I would challenge you, if you guys ever see an owner who you're like, dude, they fucking have made it. They kill it. What are they doing? I promise you that's the wrong question to ask. Instead, one of the questions I always ask, what don't you spend money on that you think other gym owners less successful than you do? What don't you spend money on? I have never looked at the balance sheet, cash flow statement, P&L of a very successful gym and seen waste. I've seen things that could be tweaked and optimized, but I've never seen gross waste in expenses, because that's what gets us all into trouble. All right. So here's a great case study here. Problem. You're a gym and your membership sales peak in Q1, quarter one, which is January, February, March here in the States if you're on the 4-quarter system. Okay. Q1, Q2, we get a surge. Okay. That's probably maybe New Year's resolutions in springtime. For whatever reason, your market does really well. You do good fitness sales during that time. However, historically you slump in Q4, October, November, and December. It's the holidays. People are traveling. You just have never been able to make it click in Q4. And it's mainly due to the lifestyle and the economy and all the kind of stuff that happens during those months in the United States. Now, during the peaks, your gym can generate over $50,000 per month in gross revenue. And your operating and payroll expenses are only about $38,000 per month. That leaves you with $12,000 in gross profit on average over that 6-month period, Q1 and Q2, where you do really well. Well, during the slumps, right, Q4, payroll gets tight because you're not selling a lot. There's not a lot of people trying to sign up for a new 6-week gym membership during Thanksgiving, right? It's a tough time. So your payroll gets tight because you don't have a lot of new revenue coming in like you did in Q1 and Q2. And your normal operating expenses and payroll about $38,000, it leaves you with hardly any profit. So as a problem, so as you guys answer this, you could answer in the chat, you can whatever, just do, speak amongst yourselves. what would a proper cash management strategy look like? If you're a gym owner and you zoomed out, dude, I kill it in Q1 and Q2, but I always eat shit in Q4. What would you do? Like, what is a logical strategy you would put together? Right? Well, number one, you might purposely, there's a couple options. You might purposely reallocate your profit in Q1 and Q2. So, hey, let's go back real quick. How much were we making in profit, everyone? $12,000 on average gross per month in this scenario. Well, hey, during Q1 and Q2, I'm not spending that money. I'm not going to the CrossFit games. I'm not buying 12 new Rogue Echo rower bike, ski ergs, whatever. I'm taking a good chunk of that cash and I'm hoarding it for the winter. I'm like a squirrel collecting nuts. I'm going to stash that because Q4 is a hellfire. That is a cash management strategy. All right. You could also strategically reduce your schedule and thus lower your payroll in Q4. If you know Q4 brings in less new revenue, okay? Well, then what can I do to lower? Because again, what are the only things you are in control of? Your expenses, your payroll, those knobs you're in control of. I'm not saying turning them off or lowering them down is easy. I'm not saying you having to go to 6 of your part-time coaches that chew up $2,000 a month in payroll expense and saying, hey, guys, I'm furloughing you in Q4. We're reducing our class schedule. I don't need all the work. We actually have the lowest attendance of the year in Q4. And even though it might upset your extra money that you make as a part-time coach here or whatever it is you do, I'm sorry, but I'm a CEO and my job and CEO is to make hard decisions for the business to thrive, not survive. Anyone can make something survive to make it thrive. It's just a hard conversation. I'm going to bring you back to normal schedule in Q1, but I have to conserve cash in Q4. You could also cease additional spending that is not critical to business operations in Q4. Oh my God, Stu, Black Friday special. I need 45 more wall balls. Of course I do. The other ones I have are kind of dusty. I need a better client experience, more wall balls. No, you fucking don't. Stop buying a ton of equipment in a quarter in this hypothetical scenario in which you're not generating as much revenue as previously. Develop seasonal offerings during Q4 to generate additional revenue. All right. Well, if we know it's going to be a bad month in Q4 or a period in Q4, how can we generate money internally? What kind of internal campaigns can I run? Can I create my own version of 75 hard and charge money for members to participate? Can we do some promotions, something like that in Q4 to start pushing, hopefully inching up on the revenue gap that we experience? These are all things that would be conversation to be had at a high level if an owner wanted to improve their cash management. Because remember, cash management is just how well you can control these things. And even this last bullet point, you can't control that. That would be aspirational, it would be hopeful, right? You've got a goal. But the other ones are 100% directly related to how you manage your cash and how you think about storing nuts for the winter. Questions, comments, concerns? Hit them here live, guys. You always hit us back up on the Facebook group as well, or send us an email afterwards. But what you guys got?
Yeah, awesome. Yeah, if anybody has, is that camera working? Yeah, okay, cool. If anybody has any questions, go ahead, put them in chat. I know we had a couple comments Jocelyn had spoken about before the slide popped up, Stu, like a pre-sale or boosting revenue, anticipating the lull in sales, and then on the flip side of managing expenses, working on promotions that will increase the positive influx. So that is definitely something that owners should be aware of as a strategy. But I do want to remind everyone that you can't always be looking to sell more. Expenses definitely need to be managed. Stu, could you do me a favor while I wait for some questions to pop in? Can you go back to the slide that broke down the cash flow statement
Sure.
into those three sections? I really like this slide, and I want to make it super simple for everybody to understand this, because this is actually how I managed my businesses on a pretty regular basis, weekly, monthly, definitely, if not weekly. So the operating activity section up top, this shows you what cash does your business generate, right? From operations. That's why it's called operating activities. So whatever you do, and Stu already explained this, whatever you do in the gym, this is the area that tells you, hey, are my operations actually efficient enough to turn a profit? So this is obviously going to be of the utmost concern for every single business owner, every single gym owner. The next line down, investing activities, I do see a lot of people get confused, and I'm curious as to your standpoint on this, Stu. I actually was in here a lot because we spent a lot of money on equipment, and every time I bought equipment that wasn't, a replacement part, that wasn't under repairs and maintenance, it went into investing activities. So, and we had a quarterly budget, and so investing activities actually was something that I paid attention to, in the sense that anytime we bought an asset, it was going to get there. And anytime I built something in and around the facility, like a new front desk or whatever, anything like that major would go there. Correct?
Yeah. Again, anything you guys buy that you could sell later, again, aka have a future benefit to you, even if it's
Future
for
value.
less than what you bought it for, would go in here. This is definitely the most anemic section of your cash flow statement
Yep.
because hopefully your operating activities are going to outshine significantly what you could sell these depreciated assets for.
Yep, absolutely. So, but I do see a lot of gym owners classify, like, when they go buy the rowers, it shows up on their P&L as like an expense for the month, as opposed to the investing activities. It could show up on your P&L, but I wouldn't recommend working things necessarily that way. I think it'd be better for most gym owners or most business owners to see that go into the investing activities. And then the financing activities, I don't know, we have 40 people on this call right now, and there's going to be hundreds more people that watch the actual recording. I'm not sure how everyone pays themselves, but I know where I was at the end of running the gyms, it was a combination of salary as an employee and distributions, owner's equity, stuff like that. So anytime I paid myself, yes, my salary, the cost of what it would be to replace myself as an employee, was represented on the P&L under operating activities on here on the cash flow statement. But the financing activities would also show the distribution that I took as an owner, correct?
Yes, and to both those points, just to the one he made previously about the P&L and L and the equipment, you can have them on both. You can have a vendor
Yep.
line on your P&Ls, and Forrest is right, it would go here in investing activities. And then on this one, yes, if you, especially in the States, if you classify as if you're an LLC and you elect as an S Corp and you pay yourself a distribution, which is a percentage of your profits, whatever you decide, plus salary would go to operating activities because you are an employee, you are a mechanism of the machine. Okay. But as an owner, you're not. As an owner,
Right.
you're just taking out. So that would go here in section 3.
Cool. So, do you know of any best practices or anything that you might recommend uh, beyond what I would probably recommend? Is I'm trying to every time I work with business owners, I try to get them to see the business from those two standpoints, and using the cash flow alongside the P&L so that they can see what it looks like. Hey, this is the business operating without me versus with me. These are the investments that I'm making into the business. I'm taking these profits and I'm putting them back into the business, and I can look at my investing activities and engage ROI that way, as opposed to having everything on the P&L,
Yeah.
which usually can cloud some decision making.
Yeah, and honestly, I'm hesitant to find most bookkeepers who will even put distribution on a P&L because it's not, like you said, it's not an operating expense.
Right.
It's, remember, so that's the thing with P&Ls, guys. And if you go back to that webinar, I think Zach and I talked about this. A P&L will show profit, and you can be like, bullshit. I don't have that money. Well, you might. It's just showing this is what you made and this is how much it costs to make it. What you do with it, come over to a cash flow statement now, right? And
Yes.
you look at section 3, you can see if that cash flow is going to pay you. Is it going to pay back loans? That's why sometimes you will not see bank loans being paid off on P&Ls, right? You'll see those being paid off on the cash flow statement. So P&L is much more in like, in my opinion, like a day to day, like, okay, like, oh my God, why did our cleaning company 2x our cost that month? That's crazy. Versus the cash flow statement is more of a macro, right? So you got this like macro view, cash flow, and then like kind of you can zoom in more, let's call it a meso or a micro is going to be your P&L.
Yep. I love that. So like the P&L gives you like, hey, this is what my operations generate, and the cash flow says this is what my business is doing with the money, essentially.
Mm-hmm. Yeah.
And I do think it should be everybody that's listening to this call and everybody that watches. I do think it should be something that you, if you don't do it on a regular basis, you should practice. You should put it into your monthly, if not weekly, checklist of, hey, let's watch the P&L alongside the cash flow. One of the aspects of management is to be able to measure it. So a couple things that Stu said early on that I really want to reiterate. It's very similar to push press core. It's very similar to your CRM. If the data that you're putting into the system is not accurate, it's going to spit you back garbage. So make sure that your accountant, if it's not you, your CPA, your bookkeeper, whoever it is, they have a good chart of accounts set up. The categories are good. The way that they are classifying the expenses and the revenue is accurate. You're going to need to work alongside them and make sure that those things are accurate so that when you look at these reports, or even when they look at the reports, they get something, you get something that is useful for you to actually manage. That's step number one. Uh, Start there. That's the best thing that you can do. Stu, thank you so much for this. I do have John Mack asked a question. When you are calculating the value of your equipment as assets, are you trying to estimate the current market value?
I do. So we do a lot of A&M, so acquisition and mergers, or so essentially selling of gyms or absorbing of gyms. And I'll generally take you take all your equipment, run an inventory on it, piece of equipment, quantity. I will get the current MSRP, right? The suggested manufacturer's price of what that would be today in real time. And depending on the piece of equipment, it could be 30 cents on the dollar. If it's a concept two rower, you're definitely strong to go about 85 to 90 cents on the dollar, pretty easily. A lot of people can go 1 to 1, but it's yes. I would be looking at the fair market value of the product. What would it cost someone to buy it today? And then I would take a percentage off of the, 30 to 90 cents on the dollar, depending on very few things are going to go to 90. Based off that. Essentially, again, if you're in that situation where I'm looking at selling it, what could someone buy it new for versus what could be for today? If he's looking at this and saying the value of the equipment and the assets, you're going to talk to what your depreciation schedule is to your CPA, because when you bought it at $1,000, depending on how your CPA or your CPA, technically your bookkeeper, is calculating your depreciation against it, that's going to be a specific amount of money. Just like if we needed to know an amortization value on loans and things like that. So depreciation on your equipment, CPA or bookkeeper, that is going to be a very specific answer for your specific situation.
Yep. The depreciate, like the IRS puts out a schedule that the CPAs typically follow, and it's standardized across industries and equipment types. So if that's what you're asking for, John, I would get with the CPA. Taxes are coming up. It's tax season right now, right? Yeah, look into having that conversation with them. A couple things. Christine made a point. Actually, this is actually a pretty good thing. She goes, not sure if it's in the plan, but a budgeting call would be good. Would you be down to do a call about helping gym owners craft a solid budget, Stu?
Yeah, and we currently, I mean, something very that's where we talk about financial models, which all
Yeah.
financial model, yeah, I mean, that's essentially, Chrissy, that's our financial model course we have inside of PushStart. That's essentially taking a look at, okay, this is the money that comes in and where does it go? That's all budgets are. Budgets are more, they're a negative restrict, like it's don't spend more than this. I use the same language. I just call it, allocations. So if I make 30 grand a month, how much am I going to allocate to payroll? AK, what's my payroll budget? Same exact thing. Check out that financial modeling course. I think you'll really enjoy that.
Christine, yeah, there's definitely. Now that I'm remembering it, I can get the link to you if you ping me. I might work to maybe host like small group workshops on something like that that builds off that course call, Stu, because that was a
Yeah.
phenomenal call. Sean Johnson, what are the general chart of accounts you guys see gyms have and any recommendations on percent allocations for each? So I'll take this one real quick. Just so you know, Sean, in PushStart, we have an example chart of accounts that you'll be able to find. And if you use that alongside the call, the webinar, the recording that Stu just spoke about, I think you'd be set with everything. Darius asks, any thoughts on leasing versus buying? Wait to buy until you can afford it or go into debt with a lease? And I'm assuming he's talking about real estate.
Yeah, and Darius, trust me, you're going to go into way more debt if you buy something than you will with a lease. Number one. Here's what I'd recommend. Right, from my perspective, there's 3 stages you've got to hit before you are bankable. So you have to be leasable. So you got to have a good enough business that a landlord would let you lease the building because he thinks you could pay the rent. That's step one. All right. Step two, you've got to be bankable after that, which is then, does your business now generate enough cash flow for someone to give you money? So step one, will someone give me a building to rent? Step two, will someone give me money that I can spend on buying a building or expanding my business or whatever? And then step three is buyable, leasable,
He's actually
bankable,
asking
buyable.
about rowers and bikes now, like equipment.
Oh, leasing or buying equipment. Oh, my bad, dude. Yeah, so check it. No, if you in the open gym models, I do a lot of leases, mainly because when you look at the cardio equipment for 10, 6 to 12 grand a treadmill, it doesn't make any sense to buy something that becomes obsolete. For most group fitness models, buy it 100%. You can do lease to own models. I don't recommend certain brands that charge you 28% interest rates to buy it out for $1 at the end of the lease. But I would buy cash. In our industry, the startup costs on equipment are very low for group fitness. Just buy the equipment outright.
I was putting in the chat the links to all of our videos. Our marketing, we do a terrible job, guys. This is totally my fault. We do a terrible job of getting all these resources out to everyone, and I'm working on that. But pushstart.pushpress.com has everything that you guys need as far as the course creation that we've done, the course content, PDFs. You can always email me, Zach at pushpress.com, to get more information on this stuff specifically. We are working on a better way to get it in front of you. A final question right here from Austin Sullivan. Do you guys have any recommendations on software that will keep track of bookkeeping, the P&L balance sheets? They were using bench accounting, but recently sold the business, looking for someone new. Pilot is one I've heard is good. What do you have?
So all those like bench pilot, they're all like kind of this one to many kind of accounting software solution. Me personally, hire a bookkeeper and use QuickBooks. QuickBooks integrates with everything. It's been around the longest. You don't have to worry about it getting sold. And if it does, it's going to stay as it is. I promise you that. Um, I'd hire a bookkeeper, a human being. Now, this could be remote. I'm not talking they have to be in your city or anything like that. They just need a human being bookkeeper. Go on Upwork, look at the different brands out there. There's, Insight, there's Score, there's a handful of different fitness industry specific financial firms out there. But a human being that's a bookkeeper and QuickBooks, in my opinion, is all you need.
Yep, I totally agree. QuickBooks allows them to work remotely and it gives you great access to the information. Um, Rosalinda just put in her number if you want to reach out to her for help. But I definitely agree with that, Stu. It's like talk to someone that knows your industry, knows your business, because getting these reports, especially if they're just filled in based off of their basic understanding, it's going to do very little to help you actually manage. So, Christine, I'm glad that you found the course. That's awesome. As we wrap up, I just do want to remind everyone, yes, we have pushstart.pushpress.com. That's where all this content lives. Thank you so much for joining us. And I'm glad that you guys found a ton of help. Stu, can you see the chat? We're getting a ton of people chiming in saying, thank you. This was incredibly helpful. So I'm
Oh, hell
glad.
yeah.
And we got a couple people that asked for more financial management specific webinars. So
Awesome.
I'm glad for this. Everyone, thanks for coming on out. You will get an email copy of this recording here within the next couple of days once the editing team gets to it. And I'll let you guys know when the next course is.
Take care, guys.
Awesome. Take care.
See ya.